My name's Kirby Bartholomew. I'm the chairman of the MIT Venture Lab program. And this, we have 4 or 5 of these programs each year. This is the February event, obviously. We're here in February, and we're talking about venture capital. We have 2 more this year. In April 20th, we're having a Meet the Angels session, where we have most of the angel groups in town going to come and talk about what they're looking for, and specifically if there's their particular focus. And then in June, we have a demo, our annual demo program, where we have a number of the startups that have specific products. We go through about a 2-month process of winnowing them down to 6 groups or 6 products, and they come up and do demos of those. So that'll be fun. In between times, the other MIT program, we have an MIT Enterprise Forum program, which is more focused on technology, kind of different fun pieces of technology. They're doing a March session on artificial intelligence and robotics. And then in May, their last meeting for the year is called The Future of Fun. So they're looking at gaming and a few other things around that. So that's what the MIT has going. This particular program, if you haven't been here before, is really focused around providing startup entrepreneurs with the knowledge they need to more effectively start their companies and learn about different aspects. If you're here, we had a session in September which was around all the resources that are available in town for entrepreneurs. And as I said, we're doing the next one is around angel investing, and the final one is a demo of products in June. So tonight we've got a panel of VCs, and they're going to be up here in a moment. John Seacrest is going to moderate the panel. John's from the Angel Group, but we've got Bill Bryant, Chuck Stonecipher, and Steve Hall, and they'll introduce themselves when they get up here and tell a little bit more. We've got some stuff. If you've read the program, you saw their bios, but we've got a little bit more information about them. But to get off and kind of get the program started tonight with a little bit more of a baseline, so we all know the kind of the terminology and so forth before we get into talking more deeply about the VCs. We've got Andy White from PitchBook, which is, you might have all seen, PitchBook's been in the press quite a bit lately. They've had gotten some new funding. They've been growing quite rapidly here in town, but they're based here in Seattle. So Andy's the head of their analyst group. So he's going to talk a little bit about what they've seen over the last year or so and surprise us with some new stuff. Andy?
First of all, thank you all for having us here. My name is Andy White, and I'm an analyst with PitchBook. For those of you who don't know what PitchBook is, which I would assume is most of you, we're a local financial data provider, founded in 2007, and we focus on collecting intelligence about the private equity, venture capital, M&A spaces. So we're primarily focused on tracking deals, equity financing rounds, debt financing rounds, and we also track everything that's kind of involved with that process. So service providers, law firms, investment banks, the actual investors, partners on deals. We also do fund returns, limited partners, all that kind of stuff. So that's my really weak sales pitch. I'm not a sales guy. So here are just some raw numbers of our data points. This is basically all of the stuff that we track in our platform. So lots of stuff in there. I encourage you to take a look if you haven't already. But anyway, let's get on to the data. So I'm going to talk a little bit about a couple of interesting trends that we've seen in VC in general over the past decade or so. Particularly, there's some really interesting stuff happening at the later stage rounds, and there's also some really, really interesting stuff happening kind of at the really early stages. So I'll get into that in a second. Just to kind of start off, for those of you who aren't too familiar with sort of the life cycle of a company's funding, this is just some kind of a very basic outline of that process that a company might go through that I stole off the internet, so I can't actually take credit for this. But essentially, a company is in the explore concept stage. It's you kind of thinking, hey, I think this is a great idea. Maybe let's go and investigate this. Then you ask your mom and dad or friends if they'll put in some money for you. Then maybe you'll join an accelerator program, see if you can get some funding that way, talk to some local angel investors. maybe a seed stage VC fund. From there, maybe you'll land a Series A and so on, and then you kind of move through those Series A, B, C, later stage rounds where we're seeing people raise a bunch of money up until the end goal to IPO or get acquired. That's kind of how that runs through, and then across the bottom there, you can kind of see the relative level of funding that's going to be. It's obviously a lot of variation with that. So just kind of a little background. So to start out, I want to just talk about what's been happening in VC that everyone's heard of. This is the stuff that's happening at the later stage round. We're talking valuations are super, super high. So this is just a chart showing the bars is aggregate capital invested in U.S. startups. The line is the number of deals that represents. So this is angel, seed, early stage VC, late stage VC. Obviously a huge, huge upward trend. Up and to the right, lots of growth. Interesting to notice, 2015 took kind of a nosedive a little bit in the number of deals, but still did $10 billion more dollars. So what is that saying? There's a lot of big deals. As you can see, these couple of call outs here, 60% of the dollars in 2014 were in later stage rounds. So we're looking at, big rounds. Again, this is just kind of on a quarterly, same data, quarterly view. So you can see downward trend with the number of deals again, but the capital invested is really staying pretty steady. Again, big deals. And so what's driving that? 100 deals in 2015, the check that was written is over $100 million. That's a ton of money. For those of you who kind of follow the industry, the term unicorn is probably something that you've heard before. It's essentially a private company that reaches a valuation of $1 billion or more. In the case of Uber, 65 billion, what they're raising right now, I think something like that. These are pretty drastic numbers right here. Over the past 10 years, 131 U.S. companies have raised over $43.3 billion just between that group. The explosion from 2013 to 2014 and last year in the number of rounds that these companies are raising has just been incredible. So that's really a lot of what's going on, is just these later stage rounds that are just gigantic. And so, of course, included in this is Uber, Lyft, DraftKings, even Zulily here in Seattle, Facebook back when they were private, Twitter. So here we're looking at the median pre-money valuation for those rounds, broken down by, we see Series C and then the D plus rounds. Just a massive increase since sort of the financial crisis there. And this is happening at all different stages. So that's, again, just driving this massive amount of capital that's going into these companies, because if you want to buy a meaningful stake in one of these highly valued companies, you gotta pay up for it. So another interesting trend, like going right along with this, is that we have a lot of quote unquote tourists. That term is thrown around. I don't think it's the best description, but essentially non-traditional VC funds that are participating in these later stage rounds. You have Fidelity, T. Rowe Price, Tiger Global doing these huge rounds. And essentially what's happening is these firms will invest in a company typically after they go public, and they'll kind of trade those shares. And what we're seeing is they're going, hey, let's get them before they're public, so maybe we get a little bit better price, catch some of that first day pop, see what else we can get out of it. And so what this chart is showing is that the bottom line there is all of the contributions that US VC funds are pulling down from their limited partners. And so that should really align pretty closely with how much capital is being invested into the market. But as we can see, as time has gone on, that gap has gotten huge, and that's coming from those non-traditional VC investors. So pretty interesting stuff there. And so then this kind of leads us to, well, what's going to happen next? So this chart is showing along the x-axis there is kind of these buckets of amount of capital raised by a company. And then the line is showing the percentage of those companies within that bucket which will IPO or have IPO'd over the past 10 years. So once a company raises over $100 million, half of those companies have traditionally IPO'd. So right now we have over 500 companies that have raised over $100 million in the US, and the markets are doing pretty crappy. So we'll see how that plays out. I can't predict the future, and I won't even try. So then there's kind of a shift into what's happening at the bottom of the market, what's happening with a lot of that early stage stuff. As you can see, this is another median pre-money valuation chart. Not as drastic looking, but still the same trend. You have the seed valuations almost doubling since 2009. Series A and B both doubling since 2009. So again, companies are becoming more expensive. But what's also very interesting is that we have a huge explosion in these angel and seed stage rounds. So, kind of my read into that is it's a lot easier to start a company nowadays. You can go online and you can learn how to code, and in a couple of years you've got something, or you find a friend who you went to school with who knows how to do it, and and not just software companies, just technology in general has enabled people to start companies easier. So a lot of those people are going out and trying to raise some funding, and maybe your bigger VC fund is not necessarily going to give you a look. So we have increased activity by angel groups. We have a huge increase in accelerator programs, and that's the next slide here. So this is the number of companies going through an accelerator program over time. So just a massive increase in that. And if you take your company through an accelerator program, you're going to assume, hey, I think I've got a pretty good shot. I've got a good product. We made it through, and we're going to continue to look for funding. So what's going to be interesting is to see, is that funding available from the investors who are able to actually write the check for the seed stage or the Series A and so on. So there could be a bit of, to bring up an old term from a couple of years ago, a bit of a Series A crunch, where there's so many companies out there wanting to go get funding, and the VCs are sitting there and they're saying, well, we are going to be as selective as we always are. We have more options, so we're actually in a better position. We don't see a crunch because we're good. So, it's competitive landscape out there. What is kind of encouraging, though, if we look at US VC fundraising. So as we can see in 2014 and 2015, there's a lot of money being raised by VCs and a lot of smaller funds. So we'll probably be seeing those smaller funds be looking towards the early stage rounds, and then hopefully we'll see some of that pick up as they move through the stages. So that's kind of what we're seeing at the bottom there. So let's look at Washington a little bit. Just for a bit of perspective in the Northwest here, this is just total funding by the company headquarters in between British Columbia, Idaho, Oregon, and Washington. As we can see, Washington pretty much dominates, which is cool. I'm from Washington, I've lived here all my life, and so I like to see this. I think part of this, there's an upward trend. I think there's a lot of tech talent here. There's a lot of, there's some good, strong healthcare industry. I think what might be happening a little bit as well is, San Francisco, the Bay Area, it's a really expensive place to have a company. It's super competitive for really good talent. Rent is expensive. You have to provide meals for your employees every day. So I think those kind of expenditures are not as much a requirement necessarily up here. So could be creating a little bit more attractive place for companies, who 10 years ago might have thought that they had to move down to the Bay Area to succeed. So then this is just deal flow in Washington itself over the last decade. Up and to the right again, some really encouraging numbers here. We can see the green line here is going to be the number of deals out of the total number of deals that are first-time fundings for companies. So we have a lot of companies starting up and getting some funding. So that's great, and hopefully, they're able to raise follow-on rounds and continue to grow. It's really cool to see this, in my opinion, because people that I know work at these companies, and it's just exciting. Again, kind of mirroring the trend that we saw on the national slide there. Huge explosion in the angel seed. We've got a lot of young companies coming up, getting that initial round of funding. The early VC and later VC lines are pretty flat. So that's, we'll see how that works out. The number of VC firms in the area has pretty much stayed about the same over the past decade from what I've seen. So we'll see kind of who's able to step in and fill some of the next round funding gaps. This slide is showing us the number of unique investors in a Washington startup year over year. And so doesn't matter whether an investor made 10 investments in Washington or one, they'll just count one time on this. And it's pretty cool because we have a pretty good increase in number of unique investors investing in these rounds. So definitely attracting some attention that wasn't there a while back. And then this is just showing the same data from the last slide, but breaking out where are those investors coming from. California, as you might imagine, that's where all not all, but a huge portion of the VC community is. Washington making a strong showing there too, and then that sort of yellow line squiggling in the middle there is all the other states combined. So it's particularly West Coast. You have California and Washington really really carrying it up here. Some international interest, so it's pretty cool, pretty encouraging stuff. And that's all I have. Okay.
I'm the founder of the Seattle Angel Conference. My goal was to create a bunch new angel investors in the community, and we've been doing that for a while. So I've been paying attention to the angel side of things, and our effort has started paying attention more upstream now to what's going on in venture, so that the alumni of the Angel Conference have known places to go to. And so in that process of thinking about that, Kirby and I ended up having this conversation about, we've done this Meet the Angels question on a regular basis, but we really haven't done a very good exploration of what's this venture capital. So, so that we can have our venture capitalists understand who's in the audience, let's do a little bit of who's here doing what. So how many people are angel investors who've invested before who are engaged in the process on a regular basis? Just a couple. How many people are venture capitalists who are peers? So you got no competitors in the room, so you can say anything you want about them. How many people are entrepreneurs who have taken funding from angels and are looking to move to the VC round? So maybe 20. How many people are looking to get money from angels and can't distinguish VCs from angels at this point? Okay, so we should work on that. And how many people are just plain curious or got brought by a spouse and are wondering why they're here? Okay, so fair enough. So our goal is to sort of help create perspective, and rather than talk, and then have questions at the end, if there's something that you want us to dive into, please feel free to raise your hand. But we'll introduce our guests, and then we'll dive into a couple of questions, and then hopefully that'll turn things around. So please introduce yourself, tell us about what you're doing, and we'll go from there.
Great, thank you. My name is Steve Hall, and I'm Managing Director, head up the venture capital efforts here at Vulcan Capital. I've been doing that about 13 years. I've been doing venture capital about 18 years. I've invested about $500 million in about 60 companies over that time frame, and it's everything from seed stage technology companies to later stage life science companies and everything in between. We invest across a broad range of sectors.
Good evening, I'm Chuck Stonecipher. I'm with Trilogy Equity Partners. Trilogy was founded around 2007 or so. It was founded by the entrepreneurs who were the folks behind Western Wireless and VoiceStream. VoiceStream became T-Mobile, which we all recognize that name. And those folks decided to sort of form a fund after those exits. It's all general partner money here in Seattle. We don't have LPs. Tend to focus more early stage these days, sort of late seed stage, Series A, often sort of first institutional money in, tend to be sort of the usual suspects. A little more focused on software-based businesses, both B2B and B2C sort of stuff, and pretty focused in Seattle here these days.
Hi, good evening. My name's Bill Bryant. I'm a general partner with DFJ out of Silicon Valley, although I'm based here and have been for all of my career. We just announced our 12th fund yesterday, actually, a $350 million vehicle, which brings total capital under management to some 4 or 5 billion, something like that, over the lifetime 31-year history of DFJ. We backed 300 or 400 companies over that time frame. Some of the portfolio companies that we have here are Chef, Redfin, Remitly, which actually all three are investors in, and Veroli, Z2 Live, a couple of other things. I just wanted to spend one moment, though, just to offer some perspective, because it's always great to come back to the MIT, anything run by MIT, because when I started out in the entrepreneurial community in the mid-'80s, MIT was the original foundational organization that brought the ecosystem together, and I was party to helping this organization get going. It's always had a warm place in my heart, in particular because I actually found Swipe through this program. When I was an angel investor, that was one of a very, very good outcome. So it's a great opportunity to come back. And then the other thing I would point out is that when I started, I was an entrepreneur from '88 to 2006. When I started in the '88 timeframe, there were exactly 3 venture funds in town. So this would have been the entirety of the venture community. And I'm happy to say that there are a number of funds, Madronas and Ignition and Mavron and so forth, that are not represented here tonight, and this is not the totality of the venture community. So, okay.
So following that notion of there's these stages that people go through, right? I'm a guy and a dog in my garage, and I have an idea. And the first thing I need to do is talk to venture capitalists, right? And that's the conversation that's going on. So we'd certainly like people to know how to do stage-appropriate investing and to engage with the right people. So in the beginning, the first person that you should take money from is yourself, right? Mm-hmm. Okay. So at what point does it make sense for an entrepreneur who's working on this to start approaching angels, and when is the appropriate point to approach VCs? And specifically in that conversation, are there people who are approaching angels intending to be VC funded who are setting themselves up so that they won't be angel invested because they're doing the wrong stage at the wrong time or doing something wrong? Any thoughts on that? You wanna?
Yeah, sure. I think we're going to have slightly different answers because we kind of have different strategies in the marketplace. So it's a good jumping off point. John shared some data about, capital raises and what the sources are. And the only thing I would say about that is that I think he talked about up to 1 million angels and micro VCs, and then the 10 million round you're looking at VCs. I think that's pushed beyond that. I think what we tend to see at DFJ is that the companies that are approaching us have raised somewhere between 1 and 4 million, or 1 and 5 million even, from micro VCs, seed investors, angels, accelerators, crowdfunding platforms, lots of other vehicles. And Steve and Chuck actually have more active early stage vehicles than we do. We used to do that sort of seed investing. Over the last 10 years, though, we've seen this explosion of professionals who are really focused in this area doing that. So approaching me at early on is just it's a futile conversation, really.
One way to think about it is people like us, one of our biggest constraints is how much time we have. And so we have to put a certain amount of money to work to justify the time it's going to take to spend the time with a company. So that tends to drive a little bit the lower limit. And we have it's related a little bit at that time, and also the fund size. Bill just talked about the size of his fund that he's raised. There's a finite number of partners who have to put that amount of money to work, and you can do some math that says, okay, well, how many deals can an individual partner participate in, and divide that into the fund. You can start doing that math a little bit. So that's one way to think about it. Is, boy, if I'm not ready to ingest a certain amount of money, and probably the lower limits maybe $500,000 or tinier lower than that, I'm just not ready for institutional money, and your valuation comes into that too, right? If I have to take at least $500,000, well, and how much my company do I want to give up, that sort of informs a little bit about the stage I need to be at.
So did I hear a distinct difference between 5 to 10 million and $500,000?
Yeah, as Bill alluded, I think, and you'll probably get that across the panel here, different strategies based on fund sizes, focus, all those sort of things. We're, at least speaking for Trilogy, tend to focus, pretty early stage. I would call it Series C, Series A. Looking for sort of check sizes, $500,000 up to maybe 2 to 3 or something like that. That sort of range, and that sort of bridges that Series A down to Series C sort of range for us.
Yeah, just to put a fine point on that, I think we will make a couple of investments a year that are in the mid hundreds of thousands range, but a typical check size from DFJ would be 6 to 8 million in our initial investment, and looking to invest 15 million or so. And so we can't afford the time, really. We can't invest 200,000 and devote just tremendous amount of time to that portfolio company. So I would say where Chuck is in that Series C stage, we're probably one stage beyond that when companies are raising 6 to 8 million from us in the context of a larger syndicated round that might be 10, 15 million.
Bill alluded to Remitly, which I think we're all in. We were in 2 rounds before Bill was in that, and it was beyond man with a plan. They had a product. We're just getting started. But it was quite early. There was another investor who came in Series A, and then Bill came in Series B into that deal. That's a real live example, local in town here, where that sort of played out.
Yeah, I don't have too much to add. I would just say that we're slightly unique, certainly relative to Bill and his partners, and we have a single limited partner with Paul Allen, and we can change our mind and do whatever we want anytime pretty quickly. So we don't have to have a specific strategy and stick to it for 3 to 5 years. So for us, while historically and typically we're focused on large dollars, we are very active seed investors, and we might do 10 seed deals a year, $250,000, $500,000. For us, it's really a strategic approach to driving organic deal flow that we hope if we do 10 of those, maybe 2, 3 will emerge as something that we can put bigger dollars into. So we invest up and down the spectrum.
One comment I might add about that too. We find it's a little different in California than here, just because of the amount of money that's flowing around at the seed stage. We all know about the exits, call it Google and Facebook on down, and the amount of wealth that's been created down in California, and the size of checks that angel folks can write down there is different than the size of angel checks that angel folks can write up here, and that sort of changes that dynamic quite markedly, actually.
So from the Seattle ecosystem point of view, we have, I guess, we last counted 11 angel groups that are gatherings of people doing things, and their alumni are planning to go upstream. Are there particular channels that you look at to get your deals, or are people just starting with you?
I think it's sort of all of the above. The ecosystem is great. Those more formal ecosystems, whether it's the angel group or the incubators and all those sort of things. So we, for that stage, we try and keep our fingers on the pulse of all those, but not exclusively. There's plenty of companies that come up in a more, sort of less formal, sort of unstructured sort of way.
Yeah. I'm seeing nodding. Okay.
Yeah, I would, a question about accessibility. I think the venture business has become a lot more transparent and open than it was, 10, 15 years ago, where it was an opaque process. You didn't know how to get in front of investors. There are thousands. If you can't figure out somebody who's close to, one of the 3 of us on your LinkedIn, you're probably not a great entrepreneur to start with. And there's just so many, ways, the service providers, the attorneys and angels and executives out of portfolio companies, and just tons and tons of referral kind of channels.
So one of the things that entrepreneurs that I experience tend to do when they say, I'm going to go raise money, I need money now, so clearly I'll improve my chances if I just apply to everybody all at once. And so they do the shotgun approach. Does that work for VCs in town? Just apply to everybody?
No. I think, Bill's right. There's a lot of channels to try to get a referral and get a meeting, but what you have to keep in mind, there are 3 of us up here. There's not 300 in Seattle, and so each individual investor typically has a very specific area of domain expertise, investment theme that they're driving, transactions that they're looking for that they think they can get support with their partnership and investor base. And, statistics would suggest it's probably not your deal. That's just sort of the way the math works. And so a lot of people feel like, a rejection means they just haven't found the right entree. But actually, it's just we see a lot of deals and they're just not a fit in an area we're focused on. So we pass, and we pass pretty quickly because you have to. You don't have enough hours in the day to take all the meetings from all the referrals. So it's a tricky process, but you do really need to find the right match, which means an investor that's actively looking in your space.
And it's a little bit like that a dating thing. You can't just go to a dating site and you're not going to find the right relationship that way. it's not just the money. It's a relationship, and it's going to be a long-term relationship, hopefully, between the institution that puts the money in and the business. And that fit, does it fit your strategy? Does it fit what you're thinking about? You know, as a good investment. Also, is there a fit with the people? And that doesn't apply, you know, to a shotgun approach at all. It takes time to develop those sort of relationships to figure out if that kind of fit's going to make sense or not.
Yeah, particularly for investors who've been around for a while, and each of us have, I think, all tend to evolve strategies based on, you know, past results, where, you know, things that worked, things that didn't, and there's a pattern matching that happens where we're all kind of trying to identify a confluence of factors that said, hey, that worked last time, and more, you know, and I feel comfortable. I understand the business model, I understand the go-to-market, I understand the market dynamics and so forth, and, you know, we're going to gravitate towards that. So all other things being equal, I hope we all, you know, can adapt and learn and try some other things too. But we you know, we have filters, we have biases, we have, and it's really based on, you know, past involvement. So, for example, if you did a deal in, I'll just pick one space, the music industry, and, you know, it just like failed miserably because of the copyright issues and rights management and all the layers and so forth, and, you know, you're just not likely to do that one again because you feel like you've learned that lesson.
So I'm hearing that each group has a space that they're in and focused on, and really the entrepreneurs need to be doing due diligence on you ahead of time to find out what's appropriate for you, and then come in with something that matches your thesis and engages with that. So is there anything that would be a good starting place for them to know where you're succeeding? Should they all be signed up for PitchBook?
You know, I think one thing for them, there's a couple of things I can think of, and these guys can go. One is look at the other portfolio companies where investments have been made in the past, right? It's a little bit, we've put our money where our mouth is, sort of thing. So try and do your own pattern matching of this firm seems to be liking these sort of things. You know, maybe talk to those portfolio companies, or talk to other entrepreneurs around town and try and get a feel for, you know, what's interesting to those guys versus what's not.
So are you followers of PitchBook, Mattermark, and CB Insights?
No, just to be frank. No.
And that's because you're so very busy with other flow coming through already that the analysis is not helpful.
I think we look at more qualitatively than that. You know, it's just staying in the flow here locally and watching the networking flow through.
Yeah, I mean, I read, you know, PitchBook and Mattermark and CB and all that. I don't, you know, view it necessarily as a proprietary, you know, insights or deal flow. First of all, it's not proprietary because it's published to everyone. I know there's a premium service that would offer that, but at least the stuff that's on public, then, you know, everyone has access to that. But it doesn't lead to really specific proprietary insights into, you know, particular companies. So, you know, but we do subscribe. We're part. I think we do have a subscription to PitchBook and to Mattermark.
So Andy showed us some lovely graphs and showed that the amount of VC engagement at later stages was relatively flat locally, and that there was this great big uptick in local angel investing. And we see that since I've been in town, are more than doubling the number of angel groups in town. So that sort of suggests there's going to be some kind of Series A crunch for at least Seattle. Do you think there's something that the ecosystem should be doing to increase the number of VC funds at Series A?
Yeah, I noticed that chart, and I think that's a huge problem. On one hand, I'm very bullish on the Seattle startup ecosystem. I'm funding into it very actively, and I think it's never been a better time to start a company here. But you know, there's only so much Series A, Series B capital, and I don't think those two lines are going to go, you know, or do anything more than stay flat. So when you've got a 5x fold increase in seed deals, I just think you're going to have a funding problem for sure. Not all of those companies are going to make it across the finish line, and I don't know that it's a matter of we need more traditional VC capital to fund them. I think we probably just need more failures to make sure that the best ones are getting across.
It's a little related. Andy made that point. It's never been easier to start a company, right? That's part of why that's happening. You know, people can fund themselves. You know, mom and dad, friends and family. That's what's creating a lot of that growth. And just because it's easier to start one doesn't mean the quality's totally gone up with all that.
So you think, so to press on that, you think that perhaps the volume doesn't represent increase, that the quality of the company stayed the same, that the quality's gone down because of the volume?
I think potentially. Again, just because the bar's lower, it's much easier to start than it has been in the past.
And I might, put a different nuance on it. It's not maybe not the quality of idea, but it's really things that meet a venture capital threshold from a scale standpoint. That, that there are only so many really big, massive ideas in any given year. And I wish there were a 5x increase in, transformative startups that could potentially get to billions of dollars in valuation, but that's not the case. So it's not that they aren't going to be really good companies and could, you could actually make a great business, $10 million, 15, 25, 30, whatever it might be. Those aren't venture capital opportunities. They could be fantastic opportunities if they're capitalized appropriately by angels and even micro VCs even, but they're not going to get to a place where any of the three of us are going to be excited because the outcomes we're driving for are in the hundreds of millions to billions.
So in the audience, those of you that have in your mind, I am raising money, how many of you are raising money for a company that will eventually become a billion-dollar company?
Wow!
No.
I stand corrected. I mean,
Okay.
they're all right here in this room, in this very.
Now, I
room.
want to count, so please put your hands up again. $1 billion in valuation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Of people that are raising money, how many of you think you're not going to be $1 billion, but you're going to be a $100 million company? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And how many people think they're going to be a $10 million company? 1. And how many think you're going to be order $1 million company? 0. And how many think you, no, I won't ask that question.
Well, can I ask a question of the folks that had their hands up at the $1 billion stage? And be truthful, try to be truthful. Of that group, how many are going to be at 300 million revenue 7 to 10 years out? Truly in your mind, okay? Truly. Okay.
4, 5, 6,
Yeah.
7, 8.
And I say that because I think, where there's a lot of data about where public markets are at, and it's 3.3 times forward revenues right now, okay, in the SaaS market, in the big cap SaaS market. So that says you got to get to 300 million in revenue before you're kind of $1 billion in valuation.
This is a really interesting topic. I want to make a point. I think it's great to be a $10 million company, and it's really great to be a $100 million company. And I don't mind backing companies that can have an exit, let's say greater than 10, but in the 100 zone. I think you have to be very mindful of how much capital goes into those companies because it's going to impact your return. But I think that entrepreneurs can actually do much better for themselves by raising less capital and having an earlier exit at a modest outcome. When you do the forward math on dilution of getting to a Series B at $1 billion valuation, you as the entrepreneur don't have a lot of equity left. And your risk is still super high on whether you can actually exit at that price. So if I were to become an entrepreneur tomorrow, I would be raising as little VC money as possible, if not none ever, and try to own as much as I can, grow it within the means that I've got at my disposal to try to get to a reasonable exit where I maximize my economics.
So presumably the companies that you're seeing now are in the order of $1 million in revenue and that they're ready to take more. right? And so if I'm at $1 million in revenue, there's a certain amount of productivity from that company that you're expecting that translates into a certain number of bodies doing stuff. So 5 guys, 200,000 apiece gets me $1 million company in terms of revenue. Are there specific bands or places where companies just don't do very well if they're not being a certain amount of productivity or a certain size of revenue that you see as danger spots for people to get stuck in? They get up to the couple million and then stall because they can't get the outside money to go faster, or?
Well, yeah. There's it'll depend on the type of startup, the various productivity metrics around dollars per sales heads and so forth. But I think one kind of very useful back of envelope formula you can think about is we like to think about triple, double, double, double. And so if a company can go 1 to 3 to 9 to 18. 36, 72, that's a pretty interesting trajectory, but it's a very steep one, obviously. Can you have a company that can, do a triple, double, double, double with appropriate capitalization? That's the sort of thing that we're going to get interested in.
And that's annual revenue.
Yeah, annual, or ARR or,
Right.
revenue, yeah.
Okay, so you guys have been quiet out there for a sec, so let me take a break here and see if there's any questions that are floating on the top of your mind. Yeah.
Going back to this idea of the Series A crunch in Seattle specifically, I just moved from Boston, so I've been here. And I don't think it's a stretch to say that compared to the Bay Area or Boston, Seattle doesn't carry quite the same momentum as an entrepreneurial ecosystem. But Steve, you alluded to the attrition between seed and Series A as probably being a good thing. But I'd like to ask if you guys think that the rate-limiting step in successful ventures in Seattle is funding, entrepreneurs, or ideas.
I don't think any of those are rate limiting in Seattle. I think if you build a valuable company with demonstrable traction and execute on a plan, there's capital available to fund you. You will only do that if you have good entrepreneurial talent and you had the initial angel capital in the first place. But the money will be there for the success. I just think the odds of success are statistically very low. I'll just give an anecdote. We probably have 25 companies right now that we've put seed capital into. So we're not on the board, we're not active, hands-on. I mean, we're involved, but very small equity stakes. And that's in the past 2 years. I would say 5 of those I feel have either raised a Series A or are about to raise a Series A, right? So there's some stats. The rest of them, there's actually been 0 failures, so that's good. But I'm expecting there to be some reasonably soon. Maybe another 5 will raise the A. And that'll give us 10 shots to decide which ones we want to back with big capital. So it works great for me, but even companies we backed, at least 15 are going to fail, is my guess, right? That's just the math.
So even if I have successfully raised a good angel round, my probability of getting a good VC round is low.
Correct, but I come back to the prior point. If you go into it saying, maybe I could have a great business here without needing to convince Bill or Chuck to give me money. Maybe I could raise $1 million, get to some traction. It's not the $1 billion outcome, which Bill definitely needs to see to back you, but it could be the 10 or the $50 million outcome. And I only need another $500,000 to pull it off. And by the way, my equity ownership's super high, and my exit, I'm going to make more money than I would have anyway.
It's a lot less heartburn.
Yeah, so when I said they won't raise the Series A, that doesn't necessarily mean they're going out of business and going back to their day job. It means they might just stay a steady, nice business. They won't have the triple, double, et cetera, but it could be something that they still have a nice exit from, and they just sort of stay a modest-sized business, and that's okay.
So in the Seattle Angel Conference, we do a convertible note as the fundamental assumption of the deal terms that we put in. And that fundamentally assumes another round. It's sort of built into the terms. are there terms that sort of make it hard for you as a VC to take some deals because the angels did something that was weird? Or are there terms that you need to have in place when you take outside money that make it possible for you to do this take just enough and then exit at 10 million instead of 100 million? Are there deal terms that are important to you one way or the other on that?
I think, for us, a little bit of an angel. That's not. It's more about the company and can it meet those sort of criteria and the Bill was alluding to versus the financing structure. It'd be rare that the financing would screw it up at that early stage. I think, at Steve's point, it's really more about how much capital you take. Again, the more capital you take, the more dilution you get, and the higher expectations you need to get to it. It's more about the volume of it than it is the specific terms of the money that you've taken.
Yeah, there's a particular story I'll just share, just some bare outlines. But I think one of the ways that angels can really screw things up is by driving too egregious a deal early on. I ran into a young company out of Eastern Washington that had raised, they were in the advanced materials space, and they had created this amazing new material, potentially kind of Gore-Tex, possibly, who knows, but very early. But they had raised, I think it was 1.2 million, and had sold 52% of the company for that. Okay, now it's hard to find anybody in Eastern Washington to back in. I appreciate that. That's what they had to do to get things going. But here's a company that was going to have to raise somewhere in the 30 to 60 million range because they had to create a manufacturing process, build up inventory. I mean, it was going to be an expensive proposition. And I'm like, for 1.2 million, you sold 52%. I want a pretty good chunk. And then there's going to be a next round and a next round, and you're going to end up with 2% of this deal. To Steve's point, and it became unfinanceable. So that would be an example of a structure that angel investors created. They thought it was a great deal, but they've created a company that, in my view, can't raise money.
So what percentage would you expect an angel round to have taken?
I would say somewhere between 15 and 25%.
So I want to jump down a rabbit hole here. We have this new House Bill 2023 that allows you to raise local money for crowdfunding, take money from anybody, put 300-400 people on my cap table. I can raise up to $1 million that way. If I raise $1 million on a crowdfunding platform, are you going to look at them?
Will I personally look at them, or I don't know enough about how. I wouldn't want to have 300 individual shareholders right out of the gate. No way. But if they were all in some sort of unit trust and had
No,
a binding.
actually, you can't do the unit trust thing. The law prevents it.
On one hand, I think it's great to give access to a different investor base into private investments. It's great for entrepreneurs to have access to capital. I'm skeptical on the degree to which this is going to change anything materially in terms of just venture financing. I think that those 300 people who do their first few venture deals and then a year later find out they lost most of their money, which is what happens even to all of us, will realize it may not be the best investment vehicle for them. So what will happen is it'll gravitate towards more of a lead venture model, and you're seeing this a little bit with AngelList and the syndicate model they're doing, where as long as you've got enough diversity and you can spread your capital across 20, 30, 50 companies, then you might have the math to work out and diversification. But you really still need a vehicle and probably a lead investor to drive that. So I think that's how it will evolve.
Okay, other questions? Yeah, Elaine.
Yeah, In the pitch book presentation, we saw that the majority of VC funds were coming from California here in Washington State. And I was wondering if each of you could kind of say, when you're looking to spend your dollars and investments, is most of that here in Washington, or is that outside of the state?
Just speaking for Trilogy, we're focused pretty locally, and again, it has to do a little bit with that stage that we're focused on. When it's that early, it tends to be a pretty hands-on job with the entrepreneurs, and it's just easier if you can drive 5 minutes or 10 minutes to visit them versus get on an airplane. So we tend to focus quite locally these days.
Yeah, what the data overlooks is that I think it's 85% of all venture capital worldwide is centered around Silicon Valley and the Menlo Park area. So the rest of the world is competing for 15% of capital. So if you're looking at just indigenous local investors, so it's always going to come from out of state if you're raising money later stage.
Could there be some angel financings where the investors have certain rights that make venture capital after that unattractive?
Well, I think Bill talked about the most important one with his unfortunate example of rights being owning vast majority of the company. I suppose there could be some horrendous note right that sort of has something about how it converts or what sort of preferences are on top of it. Those sorts of things. I mean, the plain vanilla one's not going to cause a problem. I haven't seen ones that do that, but hypothetically, sure, it could happen. No.
So if angel round is 15 to 25% of equity, can you kind of walk through what a Series A, Series B would be-ish for equity take?
These guys are coming. It tends to be a little bit that, for the first 2 or 3 rounds, that same sort of percentage. It sort of keeps going like that. That speaks to Steve's point where he talked about, as an entrepreneur, you're going to keep giving up that much every round. And so if you're trying to get to that billion dollar company, that's why the math works the way he talked about. It tends to be that each time. It's about, again, people are coming in, they're putting their capital, and more importantly, they're putting their time to work. And they need a good stake of the company to be worth that time. When you start getting up in way late stage sort of things, Series D, some of those sort of Fidelity level that Andy talked about, sort of very late stage, almost public company level financings. It changes at that point, but first 2 or 3 institutional rounds tends to be those sort of numbers.
You see those numbers that talk to the entirety of that round, or not each individual institutional investor, each individual?
No, the whole round, and as you might imagine, that round then gets divided up, right? A new lead institutional investor, say, coming in, will have a decent hunk of that round, and typically previous investors will have pro rata rights to participate in the round as well. A lot of times they do. Sometimes flexibility gets exercised to accommodate different things, but yeah, it's the whole round that happens. Yeah.
So I have a question. Basically, it's over here. It's all negotiable to some degree, right? Based on valuation, what you're looking for, what the market is. Bill, back to your example of a great opportunity from Eastern Washington with a material technology. Certainly, what could be done about that if you saw that to be a good investment? You do a down round or convince the angel investor to take less? I mean, he still has $1.5 million invested.
Yeah, we proposed a restructuring essentially, and really what we proposed was a ginormous option pool that would have re-incented management to go forward. Because at the end of the day, we're not going to build these companies. We put capital, but we need entrepreneurial teams and executives and employees to drive these companies forward. And that was really the challenge, that after our take and the angel investors, there was going to be nothing left for management. So we said we would contemplate doing this, but it would have to be a 30% option pool, post our finance, so we weren't going to be impacted by it. You guys take the dilution. So pre-financing, that was like a 45%, option pool creation. Then they just said, no way, that's just too much. The angel investors did.
So it does.
It died.
Yes, hi. I'm visiting from the Bay Area, and I run a corporate venturing arm here, and we actually have two people here. I'm not that familiar though with how active the corporates or corporate venturing is here in Washington. I was wondering how often you're working with corporates and corporate venturing.
Yeah, of the companies locally here, Microsoft has just created a renewed effort around ventures and has made some hires, and I think they'll be announcing some plans there. So I think they'll get more active. But I actually don't think there are any other corporates that have active venture funds, do they? Well, Google's not here though, but I mean, they do? They used to. Wes Chan used to be here, but yeah, okay. Yeah, so.
So we have two people here. We just started, so.
Okay, yeah.
Welcome to town.
Yeah, welcome to town, yeah.
Bring some deals to you.
Yeah, so I had a question about the amount of money out there right now. So I think we saw, as the end of last year, close to $80 billion in capital VC overhang in the U.S., and that's grown from around $64 billion in 2013. You guys touched on quality earlier, taking a look at some companies that'll have to fail and maybe won't make it across the finish line. So taking that thought and then maybe looking at public comps moving lower, maybe forcing down rounds at the late stage, and heightening concerns around quality, how do you guys as investors view that overhang that's out there right now? And how do you think other investors will react in this horizon, especially as some vintages start getting towards the end of the investment periods of those funds?
So we just look at our individual companies, and they're either executing, hitting their numbers, building value, or not. We don't care about public markets. We don't care about statistics in the overall venture asset class. We care about great companies and building equity value. And since we don't have a traditional fundraise cycle, like Bill just raised his, congratulations, we don't have to worry about, do our limited partners think that there's too much venture money out there and they're going to pull back? I have to worry about whether Paul thinks that, but it's a simpler discussion. So it's not really something we think about a whole lot. We do think about people overpaying for deals, but that just means we don't participate in those deals that we think are too high priced.
We're in the same situation, and frankly, to the extent there's a pullback, that perhaps means less competition and means perhaps opportunity for us, actually.
Valuation has come up time and time again during these answers. Can you just speak a little bit more about some general rules of thumb for valuation, or just what should us entrepreneurs know about doing valuation for our companies?
When you have a mic, you have to use it by putting it close to your face.
I'll speak a little bit to that early stage. It's hard to do math, right? If it's really early revenues, I mean, clearly there's no earnings to do math off of. There may or may not be much revenue to do math on. One simple way to think about it goes back a little bit to how much money you're looking to raise and how much the company you're going to have to give up to raise that money. That is one piece of math you can do that implicitly creates a valuation, and so that you need to sort of think a little bit, well, if I'm going to have to give up 20%, how much money do I need to raise to get to the next stage I want to get to, where I'm going to have to raise money again? And given that math, I can triangulate into what sort of valuation I'm at, and do I think I can justify that? That's some of the simple math you can do at that early stage.
I'd also tell you that this is where PitchBook data does come in handy, and Wilson Sonsini and Cooley both produce reports on a quarterly basis that talk about valuation by stage. The issue is probably more that they talk about averages or median or something like that, and it's a bifurcated world. There are deals that are being valued, the Ubers of the world, at $62.5 billion, and other deals that are at much lower. So the averages can be pretty deceptive, but at least it gives you some sense of where the market's at.
So I had a question about when you go and capitalize your round and you have lead investors who maybe syndicate, or maybe the entrepreneur goes and has done various different pitches and you have a sort of a bidding war. Eventually you need this ecosystem of board members to get along in the investment. Do you have any guidance for entrepreneurs out as to how to assemble your investors and the board members such that the company can thrive from their input rather than their animosity towards each other? Because I know it's club and it's competitive club. So any guidance for entrepreneurs on how to assemble the board?
I think tension amongst the board is a great thing. If everyone, agrees, then you only get one perspective. So I've worked with many board members that I like and many that I don't like, but I've never viewed that as dysfunctional to the company's value creation. I think the key is really structural, and you want to make sure, to the extent those board members represent investment dollars, you want to make sure those investment dollars are aligned with yours. And that means that regardless of the price you paid to get in the deal, that you have similar preferred terms and liquidation preferences and proportionate outcome at any given exit value. Where I've seen things go sideways is terms get too complicated, and at 100 million exit, one investor is going to do great and another investor is going to get wiped out, and therefore you get this board dissension, even though when they're supposed to be exercising a fiduciary duty for all shareholders, they're doing it for themselves. So personalities aren't a big deal. You can always work through that.
I think you also think about, a company needs a lot of things to grow, and it needs different things at different stages, and needs to think about, well, what does that individual board member or partner bring to the table? What does their firm bring to the table in terms of the experiences they've had? What other things that they've learned from their portfolio? Bill talked earlier about, it's always a big learning thing for us too. And one of the things you want to do as entrepreneurs, you want to bring that learning to bear with the people you partner with. And every time you get to a new stage, having someone who's learned some new things, and especially some things that are appropriate to the challenges you're then faced with to get to the next stage is a good test to be thinking about.
So are there any things you wish that entrepreneurs knew before they came in? Skills they had, perspectives they had before they took venture money or tried to take venture money?
There's a long list, I suppose. We always sort of look for there needs to be, some, usually in our case, it's great technology, some great technology leadership involved in the business, but there also needs to be some good business leadership in the business. And, sometimes there's unique individuals who have both of those things. Oftentimes, it takes a couple people to bring those things to bear, and a realization that you got to have a little bit of both of those things, I think, is one thing we sometimes see missing.
I would just add a couple of things. So the best management teams I've worked with, they communicate clearly and often. I think that's key, is open dialogue with your investors and your board. And I think the second indication of operating excellence is really a data-driven, metric-driven company that is very clear on what their plan is. They're very clear on how they're going to execute on the plan and how they're going to measure themselves against the plan. And they create realistic goals, and they meet or exceed them. And so you've got to be data-driven.
Yeah, the one thing I wish entrepreneurs spent more time on is really understanding the valuation metrics in their respective industries and what real outcomes look like. Just a couple of thoughts on that. Entrepreneurs will say, well, we're going to build this company for 5 years and we're going to sell it for $300 million, without realizing that the average M&A event, the average positive M&A, not the ones that don't get done and companies get shut down, but the average positive M&A event is about 70 million, right? So you're already talking about a company that's very, very successful. It's not like you just build something and you're able to exit at these amazing valuations. E-commerce companies, they trade for between 1 and 1.5 times revenue, okay? They don't trade for 10 times revenue, okay? So just having that understanding and the reality of what is it that you're trying to build, and then we might still get there on an e-commerce company, but we can't get there if the entrepreneur is thinking, I build this company and it's going to be at 5 or 10x revenues, because that's not where the market is valuing.
Uber's got 20x, so I can have 20x.
Yeah, right, yeah. Right, I'm an on-demand shared economy deal, and I get the same multiple that Uber does.
So are there things that you wish that angels knew before they invested in a way that led up the deals to you?
I think newer angels that haven't been doing it as long have surprises along the way when later rounds can be heavily dilutive, and the angels don't necessarily have the dry powder to continue to invest and protect their interest. If everything goes great and every subsequent round is an up round, it's not a big deal. But inevitably, you have challenging financings and often pay-to-play structures where you have to continue to put money in order to preserve your economics, and if you don't, you get wiped out. And it's not pretty, but it's just part of how venture works. And I've seen a number of angel investors that aren't prepared for that.
Yeah, just as venture investors, we allocate, and I'm sure each of us, of my counterparts here, do as well, a reserve against your initial investment for not only for follow-on positive events, but also to protect our interests if there is a challenging round down the road. And I would guess that most angels are kind of all in on their first check that they write into these companies, and they don't contemplate the possibility that as things progress, even if it's a good company, but it just needs capital. It's just, and nobody's raising their hand to put in the capital. It's reluctant capital coming in, and there will be a pay-to-play type provision. And if you can't write that check to protect your interests, you're going to get converted.
So the data from Wilbank, Rob Wilbank at the university, or Willamette University, has the largest collection of angel data, exit data in the world. His data suggests that angels shouldn't double down on their deals. And so this, I think, is a worthwhile panel discussion, because you clearly have one point of view and he clearly has another point of view. And so we should at least dig into the nuances of what people mean about that. Did I see a hand up back here? Yeah.
Thanks for the follow-up. Thanks for the great insights. Can you speak of data, and you talk to having a real good grip on what your market is and what potential outcomes are. Can you each speak to SaaS? Because I know you're all investing in B2B SaaS businesses, and just what you're seeing. And you look at Lemkin, and there's so much out there now with a number of public companies in the B2B SaaS space, but just curious how you guys are seeing it and what you might be seeing, and if things are starting to change in terms of investment theses of how to go about doing B2B SaaS.
At some level, SaaS is just a pricing model, right? I mean, at some core level, it's a way to price your product rather than charge you a license and an 18% maintenance fee. We're gonna rent it to you over time, right? So it's a little bit of an artificial thing. It does sort of create a little bit of a risk profile sometimes for customers buying it because they feel like they can get out or something like that. But I think it's really more about, does the product add value? Is it a good buy for the enterprise? Does it fit into the workflow that they're doing and disrupt that in a positive way? We look at those sort of things more than the specifics of the pricing versus not. You can do nice economics on customer acquisition costs and all those sort of things, and it speaks a little bit to measuring those metrics that Steve was talking about. That's a nice thing about SaaS. It allows you to measure those a little bit, but don't get confused about the pricing model versus the fundamental problem you're trying to solve.
Hi. Given that there's a lot of different measures for traffic, for traction, are there some minimum amount of traction needed for Series A, whether it's revenue or number of community members?
Yeah, Yeah, it's probably an impossible question to answer because of the vast range of companies that, you know, in some cases it has nothing to do with it. We backed a very early stage company that's in the autonomous vehicle, self-driving car space, and obviously it's got, you know, no revenue and, you know, no prospects for revenue for 3 to 5 years, but it's a team that has amazing background and access to some IP out of a leading research institution and so forth. So, you know, the revenue and traffic and whatnot really doesn't apply. So it's going to depend if it's a media property or a software subscription property or e-commerce or, you know, any number of other, you know, verticals. So I don't know that there's one canonical response to that.
You know it when you see it.
If an entrepreneur has a solution to a technology problem using a completely different approach, and that approach would result in probably a multi-billion-dollar company, what's the best way to get in front of a VC to be able to at least present what they have? If you send an email, it may be just dismissed out of hand because, well, nobody can do that. So what is the best way to get in front of a VC?
If it's something that's, you know, highly technical, if you get there are subject matter experts in your field, and having a third party validate that, so it's not some, you know, crazy entrepreneur telling me that they've invented anti-gravity. It's, you know, it's the head of physics from Stanford who says, yeah, I've sat down with this person and yeah, he's actually invented anti-gravity. So, you know, we'll probably be more receptive to that type of overture. So just, you know, thinking about, you know, how do I create social proof, credibility around what on the surface might be a outlandish, crazy idea, and how do you do that? So
a lot of times people who are economic developers try to improve the process of people funding companies by putting programs in place like pitch events at universities or training professors to be entrepreneurs by running them through a program. Do you see any of those folks actually making it up to funded companies?
I can't name one in particular that I have. I mean, again, there's lots of avenues that are developing out there right now, right? And part of our job is to make sure we're tapped into all those avenues. I don't think we would sort of say, oh, this is the key way to go, or that's the key way. It's hard to manufacture it. As Steve said this earlier, you know it when you see it. You know, the great businesses, the great entrepreneurs, I think regardless of whatever those channels they go through, you know, like they're going to make progress, and the ones who aren't so good aren't going to. It's not the channel that's going to determine the success or failure of the raise. It's the entrepreneur and the business idea that's going to determine it.
Can you put a name on the university program that produced a VC-funded company in Seattle? So the university has all these programs. Some of them, one of them you said, actually made it up to VC funding?
I didn't mean to say that.
I misheard you then. Okay, so none of them did. So we should think about how that flow works or doesn't work and put our money in different ways, right?
Again, it's not about the flow or the channel. It's about the entrepreneur and the business.
Okay, so
but I think
of the
John's point is that, like, let's say the University of Washington has had business plan competitions for the last umpteen years. You know, have any of those resulted in a venture capital backed promising startup? I'd be hard pressed to name one for sure. I look at them all though. I do. I just, you know, I read the summaries and whatnot.
But they have had spin-outs from professors.
Out of the labs, but I don't think out of the business plan competitions that they've run, I'm not aware of any that.
Contour.
Okay, yeah, right, you're
Contour.
right. Okay, one. Good. All right. There you go.
So recently in the last budget cycle, the state has trimmed the Life Sciences Discovery Fund, which was acting as sort of a early prep process for biotech. right? You're part of that, right? And now it's gone. And so was that producing something that was useful or not useful? I guess none of you are in biotech, so you're not clear on the data for that. All right, I should stop picking at this. Yeah.
But I'm skeptical of any government fund.
Our company is spinning out of the LSDF fund. Sorry, our company is spinning out of University of Washington funded research from LSDF.
Whenever you get a chance to say the name of your company out loud in front of a crowd, take it.
Vervio. Thank you.
So I'm just trying to connect what you do to public policy. I know that some people think that government shouldn't be in it, and other people think that they should be in it. And are there government policies that people could do differently that would affect your life, one way or the other?
Well, I'm not a fan of taxes going into investment funds that flow into private companies, and I've not seen government funds attract really high quality investing partners, and I'd like to think that we actually do add a small increment of value in and not just pushing some application process around a government process. So I'm just pretty skeptical that any kind of government-backed fund is going to make any significant difference. I don't think they have the discernment to back the right companies.
I think having a culture of entrepreneurship in a university level, there's a certain university down in Palo Alto that's done a pretty good job of that, right? And having a culture of that around the institution writ large is a good thing. But that tends to be a much more sort of informal, cultural way of doing business and almost thinking about the world than something structured and formal and government funding facilitating. I think other universities have seen that model or are trying to sort of duplicate that culture, but I think it's as much, again, sort of a cultural thing as anything else.
Thank you. I would just admit that the NIH funds a large number of programs, and many of which have been very successful for developing new medications.
So NIH research funds from the federal government program.
Correct.
But they don't do biotech, so they're not aware of it.
Actually, as a biotech, I could submit my drug to a program and get it fast-tracked, as long as they agree that it's a great idea.
Right, but none of our guests are aware of that space. They focus on what they know and are not tracking what they don't know. Okay. Any other audience questions? Go for it, Kirby.
All three of you guys are, I think you said you're all involved with Remitly. That was one of the companies that you had mentioned. PayPal has a subsidiary that does something very similar to what Remitly does. I was kind of curious, before you go in, not specifically that case, but before you fund a particular idea, do you go out and look not just at the dollars involved, but also whether it's getting crowded and whether there's a lot of competition in that particular area for that idea?
Sure. I mean, you look for a market, right? And I tend to think about markets kind of binary. Either it's big enough that there's a chance for a huge significant sort of outcome or not. It's not putting a hugely fine point on it. It's sort of an order of magnitude thing. And then you want to understand sort of what are the competitive dynamics in that marketplace, and is there a way to disrupt it and to do so in a way that's going to be profitable for the institution? Sure, you look at those things.
I'd say any company pursuing something of value is going to have competitors or alternatives or substitutes or something like that. So I can't recall a company that was truly like I'm inventing something that has no analog whatsoever in the world. I'd love to actually meet those companies, but So I don't think they're. You're always going to have some competitive aspect because that's the world we live in, and I think all of us evaluated Remitly with an eye that if they're going to succeed, they're going to have to do it in the face of lots of people who also want to accomplish the same objectives.
So when I talk to startups that are in my incoming pool of people for the Angel Conference, and I ask them about global or international thoughts in their go-to-market, they think that going to New York is their international strategy. I wonder if international or global strategy is part of what you expect of a company that's going to be a successful company, or whether they can be a multi-billion-dollar company inside just the U.S.
Well, so I'll just take this first, but I think Remitly services an international market by definition, so they have to be global in their thought process from day one. But by and large, the companies that we're going to look at, we want them focused domestically, because the winners are going to own the U.S. market. There's always a chance to expand beyond that later, and you do face the risk that some copycat will come out of Germany or UK or wherever. But the market leaders in the tech space are going to come out of the U.S. Whoever owns the U.S. market, which is going to be 40 to 60% of the world market, is going to be the category leader. And so we would not tell an early stage company to go, split their sales resource between the U.S. and Latin America or, Europe.
I'll echo that. One of my partners is Israeli, and so has a pipeline into Israel, which is a great source of technical talent. And we don't make a large number of investments there, but we have a few. And one of our very strict criteria is, you may be able to get away with having your dev team there, but we want the CEO, we want the marketing salespeople in the U.S., and we want them to prove that they're getting success traction in the U.S. market. It sort of echoes that. And that's an example of, maybe the company's domiciled somewhere else, but the U.S. is what matters.
So the article about Tableau CEO going to London for a year is sort of off market for you.
I'm not familiar with the article, but Tableau is a big company, right? At some point, at their growth rate, it makes sense to look at sort of international expansion, but they've gone way beyond the kind of size of company that we're looking at.
Thank you. I'm going to take it in another direction. In talking about fostering this ecosystem in Seattle, we focus a lot on training and breeding the next generation of entrepreneurs and what skills they need. I think the other side of it is training and breeding the next generation of venture capitalists. How does someone get into that, and what sort of training should they get? What do you recommend? How did you get into it?
I guess one thing I would say, and I think most of my partners are that way too, is having had experience operating a business and growing a business, or being part of a business that grew. I think it's challenging to sit across the table from an entrepreneur if you haven't spent at least some time living in that in those shoes and understanding the challenges of making that happen. I think if there was a young person who said, "Hey, I ultimately want to be that," I would say, well, don't start there. Go get some business experience running something, particularly running or participating and run something in a high growth environment.
Yeah, I would echo that. I think venture is a second career, and you really need to just focus on operating experience, running a company, building value. And if you've done that for 20 years, then I think you've got the right experience to be a venture investor. I just happened to be lucky starting in the mid to late 90s when I did. I had a startup, and it ended up morphing into doing venture investing. And took me another 10 years or so to figure out what I was actually doing. But you really need the operating experience first and foremost.
Yeah, some of the larger venture funds, including DFJ, we have analysts and associates. Analysts tend to be early 20s. They got 2 to 4 years of background in working for an investment bank or a consulting firm or a startup, but it's a kind of pre-MBA type of program. They come in for a couple of years and they do a lot of work and get to know the business a bit, but then go off to MBA program. Sometimes they come back to us, sometimes they don't. Associates would be post-MBA and similar background. Almost all have had a 1 or 2 significant startup roles and have done some work there. So those are kind of some of the routes. Kauffman program is probably the best known program that's kind of open to everyone to participate in. It's the VCs it's kind of an internship program that has produced a lot of venture capitalists.
There is a group in town called Invest Canopy that's doing impact investment fund manager training. And so there are at least some people trying to put programs together. If you were in India or Africa, Capria BC also is running a training program.
I know it's hard to generalize, but is there if you're a pre-revenue company, is there kind of an informal cap on your valuation somewhere between 1 and 5 million if you're looking for initial funding?
Well, quote Steve again. You know it when you see it. I mean, clearly there's a couple in town. Probably we've got funding, last month or so that are higher than that, just based on the amount of money that's gone in. So I don't think there's necessarily a cap. It's certainly hard, if you're pre-revenue, you get those higher valuations. But it happens. It happens.
That's kind of the range in a lot of cases.
What was your range again?
1 and 5 million if you're pre-revenue. If you're
We've done some a little higher than that. Certainly hard to get into double digits.
But the Kabir's.
Yeah, that's what I was thinking of.
Yeah,
I mean, $9 million went into that deal, and we can do that same math we've talked about, right? $9 million divided by somewhere between 15% and 25%. That's a double-digit number. They do happen.
Thank you for being here tonight. I wanted to ask, beyond the usual statements that are given of, oh, we're investing in the next generation, oh, we're investing in STEM, how many women companies and women-owned companies are you seeing and you actually investing in across the panel?
Our last deal was a woman CEO. I think we have 1, 2, 3 other ones that we've invested in over time that I can think of right off the top of my head. So that's 4.
In what period of time?
Last 3 years or so.
So 1 a year.
Yeah, I guess that's roughly right. Yeah.
Out of how many companies that you're seeing, may I ask? In all your time.
Yeah, geez.
Well, we know that we get less than 5% of the VC, so I want to hear in the room. What are you seeing?
It's a double-digit percentage of the portfolio, so more than 5%.
Thank you.
Yeah, there's no question, that we, as venture capitalists, as an industry, we want to take advantage of, 50% of the population and their talents and what they can bring to bear. And we'd love to see more aspiring female entrepreneurs come to the table with great ideas. But at the end of the day, we're investors, and if there's a subpar deal led by a female executive and a better deal led by a male executive, we got to invest in the other one, in the latter, just because that's our fiduciary responsibility. So we're not, while we are, I think all of us are wide open to female executives and female entrepreneurs, and there's no sort of gender bias in terms of a filter or anything like that. We're today selecting for the very best opportunities, and they're just not being created by females today. A lot of that has to do with the fact that they're not represented proportionally yet in the technology spaces and computer programming and development. That's changing. Stanford, this year more females than males taking computer science. That's great. So, 3-5 years from now, we might see those individuals coming out with startup ideas.
I don't have too much to add. We have a couple of female CEOs in our portfolio. I was just thinking about it. I bet the ratio of female-backed CEO or companies that we've heard presentations from relative to those we backed is probably higher than that of male. It just happens to be a very low number. We just don't see that many companies with relative to male CEOs. But the 2 that we are backing right now are doing great. We're excited to be part of those.
For those of you that are familiar with New Tech Seattle, next week, I think it's Wednesday, their meeting is going to focus on female entrepreneurs. They're going to have presentations by 4 female entrepreneurs at that meeting. So if you'd like to see what the women are doing in the startup business, check it out.
Any other thoughts on the audience's point of view? So I want to thank you for being here and being participant in this. I saw some movement on my hand. It's not often that we get this conversation. We would like to expand this conversation. Are there ways that we can best do that without taking too much time or engaging too frequently in weekly meetings or whatever? Is there a good way for the ecosystem to hear what startups should be doing for VCs, or what VCs can be doing for startups in this kind of way? What should we do next as an organization? What should MIT Forum do next that would be useful from your point of view?
I don't really have a great idea. I mean, this is a good one. There's, you've got 3 of us up here. There's other folks like us in town. Part of the reason we come here is we want to get exposure too, right? We want to network, so it's quid pro quo that way. Other folks will want to do the same thing. Reach out to them.
Wonderful. Thank you very much. So thank our guests for being here.
Thanks, John, for coming and moderating tonight, and
Happy
thanks
to do it.
to the whole team for providing the great insights on the VC environment here in Seattle. As I said, next MIT Forum meeting is on April 20th, and I think that these guys are going to stick around for a few minutes here, and love to answer any more questions you might have. Thanks.
Thank you.